Normal bank interest earned locally in South Africa is entered under Code 4201. For taxpayers not yet 65, the first 23,800 of local interest earned is tax-free. For taxpayers 65 and older, the first 34,500 is tax-free. It is likely that these exemption amounts will remain unchanged in future, as SARS has announced a retirement savings plan investment product with tax-free interest. This new tax-free interest retirement savings plan will not replace the old 4201 bank interest investment. In the budget speech of February 2015, the Minister of Finance announced the introduction of a new tax-free interest investment product to help stimulate savings in South Africa. The investment product will be marketed by banks and financial institutions. These new retirement savings plan products are designed to assist citizens in saving for their retirement by offering tax-free returns. No CGT income implications, no dividends, just tax-free interest. It sounds great, but there is the fine print to consider. Contributions may not exceed 30,000 Rand in a year and no more than 500,000 Rand in a lifetime. Contributions exceeding these limits will be taxed at a straight 40%, and the tax will be recovered on your assessment. Now this is important. The interest is not taxed at 40%. The amount of contributions made in a year that exceed 30,000 Rand will be taxed at 40%. You're free to withdraw your money virtually whenever you want, and withdrawals are tax-free. It is important that tax practitioners know the tax implications involved here. Perhaps the fact that you can easily make withdrawals may mean that the money in other retirement savings products could be preserved. Let's have a look at a taxpayer not yet 65 who earned 600,000 in salary and also had some interest income from two different types of savings accounts. We can see that we've entered 24,000 Rand of Code 4201 interest earned from an ordinary bank account such as a fixed deposit. Because our taxpayer is not yet 65, the first 23,800 Rand will be tax-free and only 200 Rand will be added to our income for tax. In this section of the screen here, we can enter details of the new retirement savings plan with tax-free interest. In fact, we can use the Itemize button here to enter the details. The itemizing grid shows us the interest that we earned and the annual contributions to this retirement savings account. You can see that we earned 900 Rand of tax-free interest from the 40,000 Rand we contributed to this retirement savings plan during the year. The program shows that the excess of 30,000 contribution limit for the year will be taxed at 40% as per legislation. 40% of the 10,000 Rand excess contribution is 4,000 Rand. And this 4,000 Rand will be added to the tax due on normal taxable income in this tax year. If I superimpose the auto summary window over this window and show all the bottom line figures, we can see the 600,000 Rand salary plus the 200 Rand taxable portion of the ordinary bank interest makes 600,200 Rand income for tax. As we have no deductions, our taxable income is 600,200, and the tax tables show the tax on our taxable income to be 169,158. Add the 4,000 Rand tax due on the excess contributions we made this year to the retirement savings plan, and we see a tax amount due of 173,158. Note that the interest we earn from the retirement savings account is tax-free and is not added anywhere to income. Putting any money we may withdraw back into one of these new retirement savings plans could be a problem, as exceeding the 30,000 Rand contributions in a year means you will be taxed on the excess of 30,000 Rand at 40%. Don't see this as a bad thing. There's no such thing as a bad investment product out there. If there was a bad investment product out there, it would not last very long. Each different investment product in the marketplace is designed for a different type of investor living under a different set of circumstances. For example, the stock market may offer wonderful but risky returns over a roller coaster period of several years. Unfortunately, that may not be quite the ideal investment medium for a 95-year-old. A 6-month fixed deposit or money market account, albeit with very modest after-tax returns, may suit them better. Naturally, this new retirement savings plan product, with its tax-free interest, has a place in many taxpayers' investment portfolios. Sure, it has its pros and cons, just like any other product, each with their own different tax implications. Firstly, some of these retirement savings plans on offer may even have less ongoing fees or costs than a retirement annuity or pension plan, so the interest rate you receive should be pretty reasonable. Retirement plans like RAs or pension plans may offer tax relief on contributions made when you make them, while the new retirement savings plan offers no tax relief on contributions made. The monthly benefits received from a pension fund or a matured retirement annuity are taxable, while any drawdown income received from a retirement savings plan is completely tax-free. Having said all that, with tax thresholds as high as they are at the moment, there is little tax to be paid on modest annuity income anyway, unless it forms part of other income. If the invested capital is 1 million rand and the drawdown income is around 5% of capital, then the income would be about 50,000 a year, and the tax threshold for taxpayers who are 65 is over 114,000. Each case must be treated individually when choosing an investment product, and you may need to seek help from a reputable financial advisor. Nevertheless, it is important for tax practitioners to know the tax implications relating to different investment products when asked for tax advice by taxpayers looking to invest. One of the most common queries we get is regarding the calculation that SARS uses to determine the maximum retirement annuity contribution allowed. The maximum of RA contributions allowed is the greater between 1,750, 3,500 less pension contributions, or 15% of taxable income from non-retirement funding sources. It is this 15% part which seems to cause all the confusion. Firstly, the income must be an amount from which no pension contributions were deducted. This is the reason why SARS wants RF and non-RF income to be shown separately on an IRP5 as codes 3697 and 3698. Code 3698 non-retirement funding income is income from which no pension fund contributions were deducted. Secondly, the income must be normal taxable income. Lump sums are not normal income because lump sums are not taxed at normal rates. Nor is the taxable part of capital gains added to normal income. With exclusion amounts and inclusion rates, etc., capital gains can hardly be called normal income. Thirdly, tax-free interest or any other tax-free income cannot be used. This is where the word taxable in the formula 15% of taxable income from non-retirement funding sources comes in. You can use your normal code 4201 local bank interest in the RA 15% rule, but you must exclude the first 23,800 or 34,500 exempt portion. Only the balance is taxable income. You may also include any car allowance that you received in the RA 15% rule income, but you must first subtract the allowable travel claim. Have a look at the video lecture on travel claims for information on RF and non-RF portions of travel allowances and associated claims. Likewise, you can use any other allowances that you receive, but less any deduction claims associated with those allowance amounts. Don't forget that the 15/40 part of any foreign dividends earned may also qualify to be included in the taxable income used in the RA 15% rule calculation.